Okay, welcome to our November update. I'm Peter Jackson, the Chief Investment Officer at Cumberland. Joining me today is Phil Diorio, Head Portfolio Manager of the U.S. and Global Equities. Now, turning to our agenda, today I'm going to cover a few topics, including our outlook for the economy, its impact on forward earnings for the S&P 500, interest rates and how they are currently impacting on valuations, the historical election impact of a divided Congress, and then Phil is going to review our current global positioning and what we're doing on the global portfolio. So the first chart looks at the latest ISM manufacturing data in the U.S. The latest data for October marked the sixth consecutive month of growth and the highest reading since September of 2018. The 59.3% reading was up from 55.4% in September and far exceeded market expectations, which is shown by the dotted blue line here, and above even the highest forecast range shown in the blue shaded area on this chart. Just as a reminder for everyone, the ISM Manufacturing Index, which used to be called the PMI Index, measures manufacturing activity based on a monthly survey. It's conducted by the Institute of Supply Management, and it analyzes purchasing managers at more than 300 manufacturing firms in the U.S. It is released on the first business day of each month, so it is one of the earliest indicators of economic activity that investors and business people such as ourselves get regularly. There's also a separate ISM non-manufacturing report, or the ISM services report, that is released a few days after the ISM manufacturing report. Now, the ISM Manufacturing Index is a composite index that gives an equal weighting to new orders, production, employment, supplier deliveries, and inventories. So the next few charts hopefully give you a flavor of what's going on in some of these current subcomponents. This next chart looks at the subcomponent for new orders index, which registered 67.9%, a 7.7% increase from the September reading, which was supported by the new orders coming in. It's worth noting all of this is being manufactured from reconfigured factories as a result of COVID-19 that are respecting social distancing and therefore are still expanding their output as they become more proficient each and every month. The next chart looks at the customers' inventory index, which also registered its lowest reading since June of 2010 at 36.7%, a level that's considered positive for future production. And meanwhile, the backlog for new orders has expanded at the fastest level we've seen in the past 3 months. Now, this is having a positive effect on the PMI Manufacturing Employment Index, which broke into positive territory for the first time since July of 2019. As one might expect, employment gains typically lag the other sub-indices as plants initially expand overtime hours before hiring. So we would expect a continued improvement here in the near future as plants continue to ramp up. So what we're seeing here is a classic inventory cycle coming out of a recession, led by the demand for goods, as shown by the red line here in this chart. Now, this chart is indexed to 100 as of January 2020. So overall consumer spending demand on goods is now through pre-COVID levels. And the demand is pretty much across the board, as the ISM has reports growth on 18 different manufacturing industries, and 15 of them are showing growth at the moment. A lot of the spending is being directed at durables like autos and housing-related goods. Typically, these types of spending decisions are longer term in nature. They're difficult to reverse, and generally they're a sign of strong consumer confidence. The other key takeaway from this chart is the shortfall is primarily from household spending on services, which is shown in the black line on the chart here. However, the lack of spending on services such as restaurants, hotels, amusement parks, probably has more to do with the coronavirus, and once there is a vaccine, could snap back relatively quickly in our view. So there may be some pent-up demand here. This next chart compares the jobs recovery of the Great Recession of 2008 to today. While there has been decent progress off the bottom, so far in 2020, there's still 11.1 million people without jobs. However, in 2008, the shortfall was quite widespread as durable goods consumption, equipment capital expenditures, and the housing industry all collapsed. Services actually held up relatively well back then, and it was a bit of a port in the storm, so to speak. Today, it's the opposite. Services have collapsed, yet people have confidence, the savings, and the right credit conditions exist to make those large, longer lead time expenditures, which we think would normally take much more time to come back. We think the shortfall in services today is the price we're paying to slow the virus, and no doubt could bounce back much quicker with a vaccine than it took the manufacturing industry to recover in 2008. Now consider this next chart, which shows that consumers still have a lot of cash on the sidelines. The current level of household savings is materially higher in 2020 compared to the previous two recessions of 2000 and 2008. So this supports the notion that there may still be a tremendous amount of pent-up demand, particularly for services when the vaccine is available. In the meantime, people are spending on durables such as autos. In this slide, we look at the US light vehicle sales, which, as indicated in the slide, have almost recovered back to pre-COVID levels. This chart shows the growth in first lien mortgage originations, either from new house purchases, which is the dark blue line, or refinance originations, which is shown in green. Either way, they tend to add new dollars for goods purchases for new homes, or through freeing up cash from lower mortgage interest payments due to lower levels of interest rates. So if there was anything we will be keeping our eyes peeled on, it might be the pace of the recovery. The unemployment rate fell 1% in October to 6.9%, or about 0.7% below the FOMC's median 2020 forecast of 7.6%, which it came out with in its summary of economic projections, which was released just in September. With this number performing better than expected, it could begin to put some upward pressure on wage gains sooner, such that the Fed's projections of no rate hikes looking out into 2023 could be pulled forward, which would likely be a potential negative for the markets. It could also curb the release of any post-election government spending program as well. In this chart, we look at the percentage of S&P 500 companies reporting positive earnings surprises going back to the first quarter of 1999. Now, as indicated in the chart on the far right, with 89% of companies now having reported Q3 earnings results, 86% reported a positive earnings surprise, which marks the highest level going back to the time when this data was first being recorded. The next chart looks at the consensus estimates for the S&P 500 for 2020, 2021, and 2022. It compares the estimates at June 30th and again as of this past week in November. Now, as indicated from the chart, the underlying earnings surprises and positive forward guidance that we're seeing are leading to material upward earnings revisions for the S&P 500 for 2020, 2021, and 2022. So earlier we compared the jobs recovery of the 2008 Great Recession to this recovery, suggesting a snapback in employment in 2020 and 2021 could be faster, as the downturn has been driven by the collapse in services, which typically takes less time to recover. If that's the case, we thought we might also compare the evolution of the S&P 500 bottom-up earnings estimates for the first and second years of the recovery in 2009 and 2010 to that of 2020 and 2021. This chart compares the first year, 2020, which is shown in blue, to the 2009 recovery shown in red. And as you can see, the path has been similar, although the pace this time around appears to be even quicker. This next chart looks at 2021, again in blue, and compares it to 2010 shown in red, or the second year of the Great Recession earnings recovery. So far 2021 appears to be tracking with a similar level of positive estimate revisions. And as you can see in the chart, if it continues to track 2010, then there's more potential earnings upside to come. Depending on the timing of the recent vaccine announcements, it would likely add further fuel to this. So this is a chart from my recent quarterly that compares the current valuation for the S&P 500 with and without the FANG stocks, or Facebook, Apple, Amazon, Microsoft, and the two classes of Google shares. The good news is that since September, valuations have receded from about 36 times to about 30 times for the FANG stocks, which is the black line in the chart here, and about 23 times for the S&P 500, shown in blue, to about 21.6 times, again, including the FANG names. The decline in valuation, for the most part, was earnings driven. In other words, while prices have come down in some instances for some of the FANG names, as discussed, the forward earnings are higher pretty much across the board, which also is bringing down valuations. Now, compared to the simple historical PE average for the S&P 500 of 16 times, the valuations do look expensive at 21.6 times. However, in the context of where interest rates are trading today, we would argue the S&P 500 is probably more fairly valued than it looks. And with the level of earnings acceleration potential we just discussed, the bias to raising S&P 500 forecasts may be higher. This chart compares the inverse of the PE, or the forward earnings yield of the S&P 500, which is shown in blue, to the risk-free rate, or the 10-year Treasury bond yield shown in red. As indicated in the chart, both earnings yields and bond yields have been on a steady decline for the past 10 years. And since the PE of the market is just the inverse of the earnings yield, it should not be a surprise that it's risen over time. What investors really need to think about is whether there is enough return to compensate them for taking on the higher risk of investing in equities versus another asset class, such as risk-free bonds. This is commonly known as the equity risk premium, and it can simplistically be measured by calculating the difference over time between the earnings yield, again, that's the blue line, and the effective risk-free rate, which we'll use here as the 10-year Treasury as a proxy, or the red line. In this next chart, we examine that equity risk premium going back to 2007. As indicated in the chart, the median and average equity risk premium being 3.93 and 4.15% respectively, which is shown in the top corner here, compared to the current level of about 3.87, which is a fraction lower, but more or less in line with the longer-term median and average. While the equity risk premium can create opportunities like it did during the spike in March of 2020 when the market sold off, or even get overdone on the downside, creating the correction we saw in the fall of 2018. Today, it's actually fairly neutral, notwithstanding the higher average price earnings multiple in the market, which, as I mentioned earlier, is more a function of the lower interest rates. Our own internal calculation would suggest the market is currently discounting about $156 of earnings as compared to the consensus estimates of $170 in 2021, which we showed you on a previous slide, suggesting there is still some upside room for the S&P 500. Obviously, if rates continue to move higher and the yield curve steepens, then this would compete against the value of owning equities, but we don't think we're there yet. Now, turning to Canada for a minute, in this chart, we compare the forward PE multiples for the TSX and the S&P 500, currently at around 16.8 times and 21.4 times, respectively. As indicated in the chart, the correlations between the indices are historically very high. However, from time to time, gaps do open up in valuation, given the higher cyclicality makeup of the TSX. In this next chart, we compare that valuation gap between the TSX and the S&P 500 to previous recessions. And as indicated in the chart, the relationship suggests that coming out of a recession, this valuation gap may close as the market shifts from growth to value, providing some catch-up for the TSX relative to the S&P 500. In this chart, we show the sector positioning for the North American plus international portfolio. As we discussed our last client quarterly in September, our large sector exposures are somewhat barbelled between what we'll call offense and defense, or perhaps growth versus value. When we look at our growth versus value equity mix, we believe an important tactic to address the current environment is to position the portfolio to benefit from an economic recovery while not fully depending on it. So as such, we currently have a slight bias towards value at about 53% of the portfolio. And again, that's up from 51% in September, while the growth side sits at about 39%, down slightly from about 41% in September. Staples make up the balance. Our growth style stocks are represented by reasonably priced positions with strong secular tailwinds that are in place regardless of the economic environment. For example, trends in the transition to cloud computing, digital payments, aging demographics, of which have only strengthened during the pandemic. They're represented by sectors in information technology, communication services, and the healthcare sector shown here in the chart. Our value style investments are more economically sensitive cyclical names in financials, consumer discretionary, industrials, energy, and materials. Phil will elaborate more on some of these names and changes in the portfolio in a second. So turning to the US election for a moment, this chart compares the historical performance of the S&P 500, shown in blue, and the average historical GDP growth, shown in green, for periods when the Democrats and Republicans controlled Congress, which is shown in the first two sets of blue and green bars. What's noticeable is that the historical performance of the S&P 500, which showed double-digit gains in both cases, and GDP growth of around 3%, were both very respectable levels. However, the third set of blue and green bars shows the historical return under a split Congress. While the performance is positive in all three, the split Congress has historically had better returns, which may explain some of the recent positive sentiment we've seen recently in the markets. Okay, so in summary, some of the key takeaways here are that the economy is expanding and the manufacturing sector is suggesting strong consumer confidence. The services sector could represent an area of stealth consumer spending pickup, and there's plenty of excess savings still on the sidelines to support that growth. The earnings outlook continues to surprise to the upside and could lead to further estimate revisions, particularly if the last Great Recession is any form of historical template. And finally, the market is not overvalued based on the current level of interest rates. In fact, relative to other asset classes, it still looks fairly reasonable. To conclude, and as a segue introducing Phil, I'll leave you with my final chart here, which looks at global PMIs for 30 different countries. Currently, the global average is in expansion at 53, which is above the 50 expansion contraction line. And of that, 23 out of 30 countries are expanding or above that 50% expansion line. Thank you. Over to you, Phil.
Thanks, Peter. So today what I'd like to do is share my outlook and my thoughts on the market as we look ahead to next year, and also touch on some of the themes that we like on a longer term basis and discuss some of the recent additions that we've made to the portfolio. So in a nutshell, as I look ahead to next year, I'd say that I'm cautiously optimistic, and there are a few reasons for that. First, we've had some encouraging economic data, most of which has become in ahead of expectations. Second, interest rates are low, and we expect them to remain low for the foreseeable future, which is good for the market. Third, we've had strong corporate earnings during this Q3 earnings season. There's been more companies beating expectations and upgrades to consensus, so that's always a good thing for the market. And then finally, we've had some promising news on a vaccine last Monday and again this Monday. So those are incremental positives. It makes me think we're getting that much closer to returning back to a normal life. And that's something that's well received by the market. So for all these reasons, I am positive and have an optimistic view as we look ahead to next year. So moving on now, based on everything I've just said, we've actually been starting to tweak the portfolio towards more of a pro-cyclical stance. And we've made some changes. We've added some new companies that we believe will benefit from an improving economy. So I'd like to talk about a couple of those names. Starting with MasterCard, which is the leading payment network on a global basis. This is a company that's been doing very well for a long period of time. But in recent quarters, they've actually struggled because 30% of their business is tied to travel. And with a vaccine on the horizon, this cross-border travel business is expected to recover. And so we think this is a company that will benefit as the economy strengthens into next year. Second company that I'll profile today is Sherwin-Williams, which is a leading paint and coatings company globally. And this business is well positioned for the recovery that's already starting to happen in the auto space, in housing, and various industrial end markets. So we like Sherwin-Williams. And the third company is Intuit, which is a software company well known for its TurboTax software program that it sells to individuals. And when you get into an improving economy, more people will have jobs, more people will file their taxes and will use TurboTax software. So that's positive. And they also have a small and medium-sized business company where they sell products and services, including QuickBooks. And small and mid-sized businesses have been impacted quite significantly by COVID. So there's a recovery that will happen on that side of the business for Intuit. So next, I'd like to talk about the positioning of the portfolio. On this slide, you can see the exposure to the various sectors that we have. It's a pretty diversified portfolio. We're not making any large outsized bets on any one sector. What we've done in the past is use a barbell approach, which basically has a balance between offensive stocks and defensive stocks. And we're going to continue to use a barbell approach. And this past 6 to 9 months has been a great learning lesson in terms of how our portfolio behaves in both good and bad times for the market. And we learned some very interesting things, especially about the offensive side of the portfolio, which includes technology. And what we learned is that our offensive part of the portfolio actually played some great defense because technology was one of the best performing sectors when we went into the downturn back in March and April. And then conversely, healthcare, which is supposed to be our defensive part of the portfolio, has actually provided great offense this year, with Thermo Fisher and Abbott being some of our best performing stocks. So when you've got holdings in the portfolio that can play both offense and defense at the same time, it's a really good thing, and it makes me feel good about the overall composition and quality of the portfolio. And so next, I'd like to talk about the geographic exposure of the portfolio. And what we have here is the domicile, or where the companies that we own are incorporated. So 62% of our companies are headquartered in the US, 25% in Europe, and 13% in the rest of the world. And at first glance, one might look at this and think that we're making a big bet on the US. But why I don't feel that way is that we own a lot of US companies that have very large footprints outside of the US. For example, Nike, Estee Lauder, Abbott Labs generate half or more of their sales throughout other parts of the world, including Europe and emerging markets. So if you were to actually look at our companies based on where their sales are generated, you would see a really good balance between the US, Europe, emerging markets, and other parts of the world. So we feel good about the geographic balance of our companies. And so that leads me into another thing that we like to talk about, is the differentiation that we have with our portfolios. We don't want to look like the index. We want to try and find companies that our competitors don't own, or companies that just fly under the radar and aren't quite yet discovered by Wall Street. And so one of the ways that this is measured is a concept called active share. And if you have active share of above 70, your portfolio is considered to be highly differentiated. The global portfolio is an 85 score on this active share measure. So it is a very differentiated portfolio. And what I'd like to do is discuss one of the sectors to illustrate that. And so talking about technology, whenever you think about technology, a lot of people would, think to the FANG stocks, which are very popular. They're very large stocks, and they've done extremely well. And we do own a couple of the FANG stocks, but in addition to that, we own other names that are probably not household names, not as well known. Companies like Keyence, which is a factory automation company based out of Japan, Taiwan Semiconductor, which is one of the leading semiconductors in the world, and Accenture, which is an IT services company. And what I found interesting was at the beginning of September, we had a fairly decent sized correction or a pullback. And during that time, it was a 3-week span from September 2nd to September 23rd. The NASDAQ, which is a technology heavy index, fell by about 12%. And there were names that fell by even more than that. For example, Amazon actually fell 15%, and there were a lot of tech names that fell, 15, 20% or more. And, what I liked to see during that time was how some of our stocks behaved. Keyence, for example, was actually up 4% during this time. Taiwan Semi was down 5%, Accenture down 7%. And so as a whole, our technology stocks fell quite a bit less than what the NASDAQ fell. And it's a way of illustrating that we have a differentiated portfolio from the market. Next, what I'd like to do is talk about some of the secular trends that we like. And we do have a long-term view. So these are themes that we see playing out over the next 3 to 5 years. And first one I was going to talk about is digital payments. This is a trend that's been going on for over a decade now, as more and more people are using debit and credit cards and moving away from cash and checks. And although this trend is well advanced in the US, there's still a lot of parts in the world, including some emerging markets, where more than 50% of transactions are still made in cash and checks. And so Visa and MasterCard, both investments of ours, are very well positioned to benefit from this trend. And it's a trend that's actually been accelerated by COVID. A lot of people don't want to use dollar bills or coins anymore. And for other people, behaviors have changed to do a lot more of their buying and ordering of clothes and groceries online. And some of that behavior change might be permanent. So these are additional drivers for Visa and MasterCard. Another trend we like is cloud computing, and we own 2 of the top 3 players through Microsoft with their Azure cloud computing platform, and Google, which is the number 3 player with their Google Cloud. We still believe it's early days in cloud computing and see some very attractive growth in the years ahead. Finally, healthcare innovation, another trend we really like. There's been a fantastic advance in medicine in recent years. The response to COVID and the ability to get vaccines in a fairly short amount of time would point to that. And there's just a lot of money being invested in all areas of science, discovery of the human genome. You've also got countries like China that want to develop their own healthcare infrastructure. So we just believe there's going to be a lot more money being directed towards healthcare, research and development, and innovation. And so we own a couple of companies that are very well positioned in the healthcare sector, including Thermo Fisher and Abbott, and feel great about their growth prospects in the years ahead. And so trying to bring it all together, we've got a favorable view as we head into next year. We've been making some changes to the portfolio to make it a bit more pro-cyclical to benefit from an improving economy. And we're doing that in a way that's consistent with our investment process, with a continued focus on high quality companies, maintaining our risk management process, which includes a lot of discipline around when we're buying and selling stocks. And we're also maintaining our approach to taking a long-term view of the markets. Without a long-term view, it would have been very difficult to stay invested back in March when it really felt like the world was falling apart. Staying invested was the right thing to do, and it's been a benefit for our clients. So overall, just to wrap it up, say we feel good about the fundamental backdrop for the market, and we're even more excited about the prospects for the individual companies that we own in the portfolios. Thank you.